Hi, it's Fungile from Frank. When we talk about investment strategies, there's no one strategy for men and another one for women, just the investment strategies for you and your life. However, studies have shown that women might make better investors and, interestingly, better long distance runners. Is this true? Is there a link? Let's dive in. If you search for the latter online, you may find a bunch of articles stating that women tend to be better at extreme distance events than men, and that the speed gap between the sexes is starting to narrow. Similarly, there is evidence that supports the idea that women can gain higher investment returns. Why is this the case? Among other nitty-gritties, a common theme carries throughout all these studies. It shows that women can often make better calculated decisions and can assess the risk more thoroughly. In the case of running, you could compare this to pacing. Studies have shown that women often avoid a competitive pace relative to their ability. This allows them to sustain a stronger pace right until the end. In the same way, women are found to pace themselves in the financial world. They do so by diversifying more, spending less on trading fees, and also having a generally long-term view on investments. As interesting as this topic may be, all that matters is this: women have on average characteristics to be very savvy investors. This is important to note as there are relatively a fewer number of women investors out there, so why wouldn't this change? There's actually a lot of common ground between long-distance running and investing. Consider this: if we wanted to tackle a specific distance of comfortable and sustainable running, we could create a training program specific to our goals by drawing on the experience of trusted others, in person or through selective research. That means we would train consistently, sticking to the plan but remaining adaptable to circumstance. We would know when to slow down and be a little more careful rather than pushing too hard and picking up an injury, as this would create an even bigger setback than before. We would also know that recovering from an injury gets more challenging as we get older. In case you haven't figured it out yet, that all these principles can also be applied to investing. Anyway, back to the investment strategies I've been talking about. Let me leave you with some great tips that can help you get you on your way. 1. Start with what you have as early as possible. This will maximize your compound interest. 2. Aim to stand on your own. Support is great, but you're ultimately responsible for your own finances. 3. If it's worth your money, it's worth understanding. Ask questions. If it's too hard to understand, then it's a no-go. 4. Spend your money on assets such as your health and education. These are the best, and make sure you definitely invest in these. 5. Calculate your risks and diversify. You never know what could happen tomorrow, so don't put all your eggs in one basket. 6. Always calculate your trade-offs. For example, if interest rate charges are greater than your earnings, then settle the debt very quickly. Also consider tax and fee implications. And finally, imagine your future self thanking you for all the investments that you have done. Well done, you. I hope you have learned something from this. If you did, why not check out some of our other content? Thanks for watching.